2017. And that will be driven by two factors. Number one, it will be driven by very positive earnings. If you look at what happened in markets last week, we saw earnings results by two companies, Unilever, I think it came out 2 weeks ago, as well as WAPCO, and they recorded very fantastic performance, both in terms of top line and bottom line. So if we see this sort of positive earnings, continuing in the market as we expect, that would be a driver for equities market performance. And the second factor which will be driving the performance of the market is the increased flexibility in the foreign exchange management structure. We now have a fully floated, sort of, segment of the foreign exchange market, which is the high and yield window. So much more investors are now getting, confidence, in the ability of monetary policy makers to sustain the recovery in the foreign exchange market. So if you combine these two factors, that should be a very positive driver of equities market performance.
Of the stock market. So the stock index on a roller coaster since January 24 seem to have continued, at least we're a bit of at least slightly above 20% on the general index. So far, so we're still among the best on the African continent. But let's flip things over and go to the treasury bills, the bills and the bond market, where inflation is a major consideration. Interest rate is also a major consideration for those who are buying bills and bonds on a daily, weekly basis. We've seen a steady central bank mop up via the two most instruments you use, the PMA and the OMO, as well as the DMO issuing government bonds as far as calendar is concerned. Do you think if we put inflation and weigh the interest rate holding tight on the interest rate side since January and inflation trending downwards, do you think we've had a bit of a decent half year so far from the fixed income market?
Well, for the fixed income market, yields have remained highly elevated, and that's attributable to the central bank's activities in the primary markets. They have continued to mop up liquidity via both HOMO auctions, which have been coming in, virtually every day, every trading day of the week, as well as the treasury bills markets as well. And in addition to that, due to the FX auctions, which have resumed, which have sort of increased, in the first half of the year, we have seen volatility in money market rates and the fixed income market in general. When the central bank comes into the market to auction off FX, it squeezes liquidity, and you see money market rates trending upward as well. So for the fixed income market, it is a whole lot dependent on central bank's response, to the developments in the macroeconomic space. And right now, the central bank's response has been policy tightening, which we do not expect to change anytime soon, despite declining inflation. Because if you analyze the central bank's decision over the last 2 years, you realize that the major anchor for monetary policy is not really inflation, but FX market stability. So despite moderating inflation rates, as long as we have a spread between the interbank rate and the NAFEX exchange rate, as long as we continue to see volatility in oil prices, as long as we continue to see fragility in external sector balance, the central bank will not likely alter its current tightening course. So that's our prognosis for the rest of the year regarding the fixed income market, with domestic fixed income market at least. But if you flip it to the other side and look at what's happening to Nigeria's foreign currency bonds, both from the sovereign part and the corporates as well, you will see that the improvement in macroeconomic indicators, it has reflected in the valuation of these securities.
And the yields as well.
And the yields as well. So if you look at Nigeria's sovereign bond yields, it's have declined significantly, same thing for the corporate bonds. And you will see that some of Nigeria's corporates actually use that opportunity to tap the Eurobond markets again for borrowing during the year. So we saw Zenith Bank and UBA going to the market to raise $500 million each. Even the federal government as well. They've raised about $1.8 billion, both in Eurobond and diaspora bond. So the improving credit quality of the sovereign and the corporates, it is reflecting more on the foreign currency borrowing, that is the Eurobond market, than the domestic market, because the domestic market is much more dependent on the central bank's response, to the macroeconomic performance.
In simple terms, globally, on Eurobond, on our sovereign bond, and the corporates from the banks, mostly, about 7-8 local banks, we're doing very nicely. Despite dollars' aggressive gain in the last 2 years against other international majors. On the outside. On the inside, we have issues locally affecting the price of bills and bonds in our domestic market. So I'm going to ask you, between now and the end of the year, what do you think would happen, should happen, to take this very sticky yields on fixed income a little bit lower from where we are, where folks won't believe that, look, the government is borrowing aggressively and paying so much premium on those borrowings?
You're right. For us, we believe that let's start from the foreign markets now, where we have our Eurobonds listed. We're trying to see sustained positive momentum for Nigerian sovereign and corporate Eurobonds, driven by the improving credit quality, of the issuers. For the domestic markets, we are expecting yields to remain elevated up to the end of Q4 2017, where we expect to have seen significant moderation in external sector pressure. Right now, the central bank will be watching what's happening to oil prices and crude oil production. If we continue to see sustained, crude oil production at 2.2 million barrels per day, although that is at risk now because some OPEC members are already suggesting Nigeria should be included in the cuts, in the production cuts. So if we do not see that happening and we continue to record peak level of oil production and stable oil prices, that might, that might give the central bank the incentive to start to ease monetary policy, maybe towards the end of Q4 2017. And that would be a positive driver for fixed income return towards the end of the year. But for now, for third quarter 2017, we do not expect any change in both short-term market rates as well as the monetary policy rates.
We still have between tomorrow's decision and September.
Correct.
But a bit of a most likely rate cut in December, or November.
We wouldn't see a rate cut, from our own analysis, because if you look at the central bank's response over the past 2 years, you will see that central bank's response in terms of rates hike or cut, it has lagged actual movement in the markets. Oh. For instance, in 2015, when we had the easy monetary policy in issue 2015, we first had the central bank stopping OMO mop-ups and significantly guiding down OMO rates before they now went ahead and slashed the MPR. Same thing in 2016. So what we expect to see is probably a moderation in OMO clearing rates, while the MPR remains at 14% for the rest of the year.
Well, thank you for that.
My pleasure.
Of course, as always, we will have you back sometime in the week. Omotola Abimbala from Afrinvest. Next on Business Morning, Johnson Chuku, the Chief Executive Officer at Cowrie Asset Management, on macroeconomic variables and decisions Godwin Emefiele and company face this week. Join us again.